Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. Let me know if you've heard this story before, but equities reached new heights driven by strong performance of tech stocks. At this point, it's like a broken record. It seems like the past 5 years, that's the story for equity markets. There's a segment of growth stocks that might get overlooked due to the huge popularity of mega tech stocks and the Mag 7. I have on the perfect guest, an industry expert, to share his insights and research into this relatively new asset class within the growth style. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and move on to the star of the show. I'd like to give a very warm welcome to Robert Zuccaro. Robert is the founder and CIO at Golden Eagle Strategies. Robert, thank you so much for coming on. It's an honor to have you on. I'm really excited about this conversation. Can you please tell us a little bit more about yourself and Golden Eagle Strategies?
Yes, Ryan, as you know, I've been doing this a long time. I started managing funds in 1978 with the Axe Out and Stock Fund, and with that fund, I broke new ground in the industry. I was early to use a quantitative process for buying and selling stocks, 10 years before Morgan Stanley introduced the first quant fund in
Okay.
1998. Also, I was the second in the industry to introduce a focus fund. I've always been known as a stock picker, and I inherited a portfolio of 85 stocks, and I whittled it down to 20 stocks. Typically, focus funds are funds that have 30 or fewer securities. In addition to that, I started my first correlation studies doing post-mortem work. At the end of every year, I take the portfolio apart because I want to learn as much as I
Yeah.
can about performance for that year. So what I did in the first time around is I lined up the stocks that were in the portfolio by price gain and earnings growth, and I found that there was a close correlation between the two, which gave rise to our mantra that price follows earnings. In addition to that, I always ask myself, and this is a very important question that every portfolio manager should ask themselves, did they add value during the year by changing the portfolio around? So what I did was I introduced a frozen portfolio concept. I measured my year-end performance against the beginning year performance using a static portfolio, no changes for the year. And for 22 consecutive years, starting in 1978, my active management return exceeded the frozen portfolio return.
Okay.
So I still do a lot of these things today. From Axe Houghton, I went on to form Target
Okay.
Investors
Yeah.
and continued to do my quantitative research and run portfolios predicated upon high earnings growth and also relative price performance. So, in a sense, I've always run momentum
Okay. Yeah.
portfolios. I earned a lot of investment accolades over the years.
Robert, it's a great story. Love the track record. Love the history. At Zephyr, we really focus a lot on quantitative analytics, investment risk analytics. When you were talking about your active trading, did the manager bring skill to the portfolio, add value to the portfolio? Just reminded me of tracking error, and some people might call it active share. Is that you started in 78? Is that kind of what it's grown into? A lot of people leverage active share or tracking error in terms of measuring managers active, how active they are over a passive benchmark.
We've always been an active manager and have had above average turnover. But if you look at the investment business, the best fund over 40 years was Magellan
Yep.
with a 14.7% annualized return. If you read Michael Carvel's book, Trend Followers, which includes a chronicle of all the top money managers in history, including Bill Dunn, which achieved a 28% annualized return over 28 years, you will see that they were high turnover portfolios. There's no way in the world that you can get to 20% or higher returns by sitting with a static portfolio. And as a rule with the investment business, the reason I went quantitative is in 1978, all our in house portfolios were underperforming the market.
Okay.
All our in house portfolios were relying on our 8-person research department. Now, if we fast forward to the past 10 years of some 2,000 funds tracked by S&P Global, only 7% of equity funds have managed to outperform the market, and the vast majority of them are managed using a fundamental approach, which means forecasts, subjective opinions, which are really right. Everything that we do at Golden Eagle and every investment move that we take is predicated upon a factual foundation, which has paid off many times.
Fantastic. You talked about, your investment thesis and philosophy in 78 was earnings, consistent earnings, companies that grow consistent earnings and tracking those on it, momentum in price. With today's current market environment, the Fed just cut rates due to concerns over the labor market. There's people concerned about the economy potentially going into a recession, which obviously would impact earnings moving forward. What's your view on the economy, and should investors be concerned about a potential recession and a slowdown in earnings?
You know, I've published on the subject and I continue to propound it. We're not going to see a recession for years for this reason. The U.S. economy is undergoing an economic miracle which few economists recognize. Since 1981, we've had 4 economic expansions that have averaged 9 years in duration. Prior to 1981, uh, expansions were limited to less than 4 years on average.
Okay.
Now, the inflection point starts really with the growing prominence of technology in the 1980s. Apple came public in 1980, Cisco in 86, Google in 98, Amazon in 97, NVIDIA, which is the first $5 trillion company,
Yeah.
and I'll get back to that in a second, in 1999. But the second factor is globalization, which has expanded the global market by 4 times. So all this discussion about recession, in my opinion, is misplaced. We've been talking about recession since March of 2022. I'm actually fatigued by the subject. There is no recession in sight. Second quarter GDP came in at an astounding 3.8%. The consensus economic view was 1.0 to 1.5, and the Fed of Atlanta estimates third quarter is going to come in as high as 4%. So where's this recession? It's missing in action.
I'm glad you brought up in 2022 and the fatigue of recession and that yield curve reversion. It's supposedly predicted every recession going back in time.
Yeah,
We're
there was
still waiting for it.
yeah, excuse me. There's a noticed economist. Can't think of his name right now. Samuelson. I had his economics book when I was in college, but he said that the stock market has predicted 9 of the last 5 recessions.
Yeah, exactly. It's something similar with the yield curve too, and we're still waiting for that recession based on the yield curve inverting a few years back. So we're talking about the expanding economy. Obviously, like you said, it grew over 3%. Is there a particular equity asset class or style that performs better during the expanding economy?
Generally, growth does better in the later stages of the economy because investors become a little bit more lackadaisical and are willing to take on more risk. Like a lot of companies, 5 years into the next expansion, they forget about the last recession and they tend to take on more debt because they're thinking what has happened recently and not what typically can happen. But the best asset class we have found is a hypergrowth asset class. In 2016, the World Economic Forum did some work on the growth stock style. And what they did was they segmented growth stocks into three different classes. The first class is normal growth, and this is based on sales, not earnings, up to 20%. Rapid growth, sometimes called aggressive growth, was 20 to 40% sales growth. And the most attractive class of all is hypergrowth stocks, which few investors know about. When I started out in 1978, I would only buy companies that had earnings growth of 20% or higher. In 5 years ago, we transitioned to the sales variable because it's more stable than the earnings variable. Meta just announced their earnings yesterday, and they commented that their sales are going to be very strong, but their earnings are going to be constrained because they are going to accelerate spending for AI purposes. So, again, that's an example where the sales characteristic is stronger. Now, the real crux of the reason why we have adopted the sales and moved away from earnings growth was a study that I did on the top performing stocks over 10 years during the period 2015 through 2019, stocks with 10-year gains of roughly 1,000 to 500%. Surprisingly, we found that 53% of the stocks that were among the biggest winners started out losing money. So by focusing on the sales metric, we can expand the pool of high potential stocks. I'll give you an interesting example. Exact Scientists, been around for many years. They've been losing money every year since 2009. Last year, 2024, they lost more money than at any time in their history. They lost $5.59 a share. The stock is up more than 9,000% over that period. And the reason why the stock is up, their sales grew from less than $1 million in 2009 to $2.8 billion last year. So we are perhaps the only advisor that focuses on sales, and it's a far better tool than the earnings characteristic, which Wall Street has a lot of difficulty in evaluating companies that are losing money.
Robert, that's a fantastic point. And there's more and more sales analytics out there, I believe, but still, earnings growth, that's what captures the headlines each quarter. It's not so much sales. It seems like the company's stock price focuses on earnings. But you made such a good point about that top line number of sales and then the bottom line number, your net income. There's a lot in between there that can impact the earnings price. Like you said, it's not a bad for a company to be reinvesting and investing in AI, and their earnings might be negative because their sales are continue to grow. Very good point. Do you find that more and more companies might be going, asset managers might be focusing more on the sales part?
You know, I could give a talk to 100 investors on different investment strategies and what works. I don't think more than one or two would listen to me because people are set in their ways.
Yeah.
And also, if they changed, they were making an admission that they were wrong. People don't like to admit they were wrong. It's part of human nature, unfortunately, but it is part of human nature.
That's a very good point. And who knows? We'll probably never get away from just focusing on earnings growth moving forward. I've seen more and more people, asset managers, doing cash flow analysis, focusing on cash flow, which is a good one, but it's probably still not focusing on sales entirely.
I spend 95% of my time on research, and all these financial ratios that are used by professional investors, particularly price to earnings, which is the most common one, price to sales, price to book, debt ratio, return on equity ratio, not a single one has predictive value. The only metric that has predictive value in the investment business is rate of growth. And that's why we buy the fastest growing companies because the fastest growing companies, whether it's earnings or sales, which is a better metric, are the ones that are going to lead the stock market and come in with boxcar returns.
Fantastic. I love it, Robert. Love the little, I wouldn't say contrarian, but a different viewpoint on analyzing stocks and a little outside the box, outside of just your earnings growth, which everyone talks about. Go back to hypergrowth. You mentioned hypergrowth, 40% growth over sales growth from year to year. What isn't hypergrowth? We could talk about what is hypergrowth, but what isn't hypergrowth?
What is in hypergrowth is the S&P 500 index and the Nasdaq Composite Index, because the S&P contains just 3% of issues that are demonstrating hypergrowth sales of 40% or greater. For the Nasdaq, it's a touch higher, it's 6%. And recently we introduced 4 weeks ago the Golden Eagle Hypergrowth Stock Fund ETF.
How do you define it? What are some characteristics of maybe outside of high sales growth that these names, are there some characteristics that they all exhibit?
There's one other, and it's technical, not fundamental. When we put these stocks in the portfolio, very often I know nothing about them. Most often I want to know nothing about them,
Okay.
because once I know something about them, subjectivity kicks in. So we are purely quantitative. So on one hand, we have sales growth. On the other hand, we have research that I've done formulating new high, the new high stock effect. And what our research shows on more than 30,000 stocks, that stocks that are trading within 10% of their last new high tend to go up on average 0.84% over the next month. For those that are trading within 25% of their last new high, they tend to average a monthly return next month of 0.73%. And for those stocks that are trading 25% or more away from their last new high, they tend to lose money over the next month. So obviously, we have the hypergrowth sales rate, and we are typically buying stocks that are within 10% of their last new high. And the last new high could have occurred 2 weeks before or 2 months before, but it's still valid. It's not time, but it's distance away from the last new high.
Fascinating. So when I think of hypergrowth, when we started having these conversations, my mind went straight to technology, right? High tech, mega tech, AI, you name it. Where can investors, or why do investors and people like myself, financial advisors, think tech and hypergrowth overlap so strongly? And is that a misconception?
No, it's an accurate perception, because many of the fastest growing companies are technology companies. And in the technology sector, you probably have a higher proportion of faster growing companies than you do in the rest of the stock market. But let's take the Mag 7. There's one hypergrowth stock in the Mag 7, and that currently is NVIDIA. When we invest in hypergrowth, it occurs across all industries. The S&P industry classification, I think, has 13 industries, or 11 industries, and we are represented in most of the S&P industries. If you get to the professional nomenclature, which most professionals use, it's called GICS, Global Industry Classification System. That's 11 industries, and we are in 8 of 11 industries. So we have healthcare industries, which can be hypergrowth stock. If you look at our portfolio in June, the biggest representation on a sector basis was healthcare. Today, it's materials companies, gold stocks, on silver stocks, which are demonstrating hypergrowth stock rates and are also leading the stock market by continuing to trade up to new highs.
Fascinating. I love that it includes materials and your precious metals like miners and companies. It's just not technology. So you do get some diversification there if you're looking to add a little bit of diversification in a hyper growth stock. You're not just all in Meg 7. So good stuff there.
Yes, one of the things we do, because we're focusing, as you know, on last new highs, we rebalance every each portfolio at the end of every month.
Let's talk about portfolio construction. Financial advisors listening, they might be very intrigued by this, but how can hyper growth exposure benefit a portfolio, and how should advisors think about this exposure in terms of portfolio construction process? Do you 5%, 10%? Is it part of your growth sleeve? How does it fit in the portfolio construction?
Part of the growth sleeve, it should be a portion. For those investors that are interested in high returns, it should be a larger proportion. I'll leave the percentage allocations to others.
Yeah.
But I think what will be helpful is to talk about a study which I've done on hypergrowth stocks and why we introduced the first hypergrowth stock products in the investment business is predicated upon a study covering the years 2009 through 2024, updated this year for 2024, which shows that the average return over 16 years for normal growth stocks is 18%.
So let's talk. Is this something where you talked about the strong performance? Can financial advisors replace some of their Meg 7 exposure with this fund, or is it a complement to Meg 7 if these financial advisors really want to gain exposure to the Meg 7? Does it complement it or replace it?
No, I wouldn't mess with the Mag 7. They are legitimate stocks. They are at the forefront of AI. Complement is probably the best way to describe the hypergrowth style.
Fantastic.
However, having said that, the investment business is rife with underperforming managers. S&P Global does a SPIVA report every year covering 2,000 funds, and they report that over the past 10 years, that only 7% of actively managed funds have managed to beat the S&P. The number drops to 3% over 15 years, so there's a lot of opportunity to replace some of the underperforming funds with a hypergrowth stock strategy. And right now, we are the only manager in the space, but as time goes by, and if we are capable of producing outsized returns, we are going to have a lot of company along the way.
Yeah, I'm sure you will. I'm sure you will. So, a lot of talk about valuations, especially on the growth side. Technology, a lot of people think we're overvalued here, lofty valuations on tech. What would you tell financial advisors who think, yeah, this space is too overly priced, we're in due for a correction in valuations? What do you tell them regarding valuations?
Okay, Ryan, in answer to three questions, no, no, no. The stock market is overvalued only using the premise of an average PE that goes back to 1926. Until 1977, the U.S. stock market and the U.S. economy was an industrial economy. In 1980, six of the biggest capitalized stocks in the S&P were oil companies, which sold at low PEs. If you look at the top 10 today, nine of the top 10 are technology stocks that carry higher than market PEs. Now, I've been looking at this question for a very long time, and surprisingly, this is very timely. I came up with the answer last week to the valuation argument, which is wrong. From 1960 through 1981, corporate profits grew at a rate of 5.3% per year, and during that period, the market PE was 13 times. Since 1981, Corporate profits growth have accelerated from 5.3% to 8%, which justifies the higher market valuations. And over that period of time, the stock market PE has averaged in the low 20s. Now, this is very important to consider. The St. Louis Fed shows corporate pre-tax profit margins of 9% in 1981, which have grown to 18% presently. So corporate profitability is at an all-time high, destined to go higher with the advent of AI. We've had two important announcements. I think Amazon is laying off 20,000 employees, and UPS has made two announcements. The first announcement was they were laying off 20,000 people. Now they're laying off 48,000 people. Most investors regard lackluster job growth as negative. I regard it as being positive because corporate profits are in a process of expanding, which means higher profitability and higher stock prices down the road. So again, I look at this in an entirely different way. And one of the things I do, I publish every Tuesday on Thursday. I talk about general themes. I don't
Okay.
talk about our investment products, but I do things that often go counterintuitive in order to help investors help themselves, just as you are doing with your program.
Yeah, fantastic. Yeah, great content. I love that you're given, I wouldn't necessarily maybe say contrarian view, but just a different view for investors, financial advisors. Open it up a little bit, maybe think a little bit outside the box. Maybe, that headline, maybe we should think of something different versus just reading the headlines every day. Obviously, passive ETFs are very popular. A lot of people invest in the triple Qs, NASDAQ for the technology exposure. What would you say to an advisor who thinks they're getting some exposure to hypergrowth, that hypergrowth style through investing in, say, the triple Qs or NASDAQ or some large growth ETF?
Well, if things go according to the past, we should be better than the Nasdaq and of course the S&P, and we should be better than most managers. So I'm not a Johnny come lately to the investment business. I've been doing this for more than half a century. So when you're dealing in investments, you're dealing with probabilities.
Mhm.
Okay? So the probabilities are higher going with a veteran that has been time tested. I've been through 9 bear markets, I've been through 8 or 9 recessions, and I've worked my way through this, and I'm still kicking and breathing.
Fantastic. Robert, I think that's a great way to wrap, put a bow on this conversation. Way to bring it all together. It's a very interesting style, hyper growth that I think sometimes gets merged too much with just the overall growth style. Great stuff there. Thank you so much, Robert, for coming on the show and sharing such great insight, your research, your data. I love it. Where can our audience get more information about Golden Eagle strategies?
I would go. We have two websites. The first is investing in hypergrowth stocks,
Okay,
which is generic. The second one, which is more specific, is hypergrowth ETF.
perfect. Awesome, Robert. Thank you so much again. It was a really fun conversation. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe to those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.